Homeownership often represents the most significant financial decision in a person's life, so it requires a structured approach. This video outlines how the choices made in buying a home can build long-term wealth through leverage, equity, and disciplined financial habits. The central concept is straightforward. Ownership transforms ordinary monthly housing payments into equity growth and principal reduction. While renting merely secures shelter, ownership allows a portion of each payment to convert into equity that is under your control. To maintain consistency in your decisions, you can depend on automation, clear affordability guidelines, and trustworthy professional advice. Begin building momentum by choosing a down payment strategy that operates automatically rather than waiting for the perfect moment. Mitigate risk by selecting a mortgage that aligns with your budget and provides flexibility for making additional principal payments. Accelerate your payoff timeline by implementing payment schedules designed to shorten the duration without convoluted plans. The focus should not be on acquiring a dream home, but rather on establishing a repeatable process that ensures consistency over the years. For a comprehensive checklist, consider purchasing The Automatic Millionaire Homeowner by David Bach and subscribe for more detailed guidance. Homeownership combines enforced savings and leverage, effectively altering net worth outcomes more significantly than typical budget cuts. Renting lacks the ability to create the same equity trajectory because renters do not control the underlying asset. A mortgage utilizes borrowed funds to buy the property, which means the buyer possesses the total asset with a partial cash investment. As the principal balance decreases and market values rise, your equity grows, providing a foundation for future opportunities. Home buyers can leverage borrowed funds through a mortgage, allowing them to utilize their home as a vehicle for wealth construction. The choices made throughout one's lifetime in homeownership can greatly influence whether financial independence is achieved. Data reveals a significant disparity in net worth between homeowners and renters, even among individuals with similar incomes. The key is to concentrate on the structural benefits of home ownership instead of relying solely on property appreciation for wealth. This entails starting with a practical first home and then replicating the process, rather than pursuing a larger home for mere status. Once your mindset is set, the next step is to formulate a plan for your down payment and closing costs without needing constant determination. A successful down payment strategy is one that employs automatic transfers and a predetermined percentage set in advance. The objective is to eliminate daily decision-making and build a reliable cash reserve for your property purchase. Begin by assessing how much home you can realistically afford, taking into account principal, interest, taxes, and insurance. Guidelines such as the FHA rule of thumb recommend keeping housing payments within a reasonable proportion of your gross monthly income. Following that, establish targets for closing expenses and a cushion to avoid depleting all your resources for the purchase. The required down payment may be smaller than you think, but it still necessitates a clear timeline for accumulation. Automation will help you manage your savings while keeping your cash targets and affordability limits visible each month. This phase also creates parameters to ensure you do not exceed your budget when purchasing a home. When your cash target is clear, searching for a home transforms into a filtering process rather than a guessing game. After laying this foundation, the next crucial step is selecting a mortgage advisor who aligns with your specific needs. A mortgage advisor is essential for comparing lenders, clarifying terms, and managing paperwork that impacts your finances for years to come. Meet with multiple professionals and choose the one who builds trust through transparency and straightforward communication. Comfort is key, as the process involves sharing sensitive personal information. Hesitation can result in overlooked details. Once you've selected an advisor, you can compare mortgage structures, choosing one that fits your income patterns and risk tolerance. A mortgage is a loan tied to the property, so making timely payments is crucial to safeguarding ownership and preventing foreclosure. Equity is calculated as market value minus the remaining mortgage balance, and equity grows as the principal decreases or the property value increases. Understanding this formula simplifies the evaluation of refinancing offers, extra payment options, and the actual costs of fees. Opt for a mortgage that supports your future goals, whether that involves moving, renting out your first home, or making another purchase. This choice is less about accurately predicting interest rates and more about selecting terms that you can consistently sustain through life changes. Subscribe to access more homeowner decision tools, including questionnaires that assist you in choosing the right advisors and mortgage options. After choosing the mortgage type, focus on securing the best deal by comparing rates, points, and closing costs. Over 30 years, the total interest paid can surpass the principal amount. Therefore, comparing offers can greatly impact your long-term costs. Request clear statements from lenders, online access, and options for making additional principal payments. Inquire about the procedures during payment difficulties, how late fees are applied, and who to contact for assistance. With a solid understanding of financing, you can approach your home search wisely by setting criteria that align with your budget and lifestyle. Instead of wasting time browsing endlessly, narrow your search by considering location, price range, property condition, and realistic monthly payment limits. A skilled real estate agent acts as your advocate and coach, but be sure to interview multiple candidates and examine their track records in your desired areas. Discuss recent transactions in target neighbourhoods, negotiation styles, and communication preferences to determine if the fit is right. Once your team is in place, commit to the process and schedule your next steps to avoid procrastinating decisions. The final advantage comes from automating your mortgage payments, allowing for quicker payoffs without constant attention. Splitting your monthly mortgage payment into bi-weekly instalments creates an additional payment each year, effectively reducing interest costs. Bi-weekly payments can potentially shorten a 30-year mortgage by up to 7 years, minimizing the need for complex refinancing options. Most payroll schedules operate on a 2-week cycle, allowing bi-weekly mortgage drafts to align with income timing, which simplifies budgeting. If your lender does not offer a bi-weekly option, a third-party service can help set up the drafts and reports for you. Request statements that clearly outline how extra principal payments are being applied to your loan. Once mortgage payments are automated, you can focus on intentionally increasing your equity and deciding when to leverage it. Embrace the homeowner mindset. Retain your first home whenever possible and leverage your equity for your next purchase. Safeguard your financial journey by preparing for housing market cycles. Avoid overextending yourself and maintain reserves for unpredictable disruptions. A bubble-proof strategy relies on conservative assumptions and the flexibility to adapt when market downturns affect prices and refinancing conditions. The next step is to share this approach with others. By offering guidance, you can amplify long-term results for everyone involved. An automatic homeowner plan begins with one property acquisition, but gains effectiveness when you repeat the process with discipline over time. Improve your results by establishing affordability limits, choosing trustworthy advisors, securing competitive deals, and automating your payments. When all these factors align, your equity grows, interest costs decrease, and your financial security improves without constant vigilance. Recognize that housing market cycles are a normal part of the process, making preparation more crucial than chasing perfect predictions. If you plan to buy again in the future, use your accumulated equity wisely to avoid resetting your progress after years of payments. Consider retaining your first home as a rental. This strategy allows one asset to support the acquisition of another. Another impactful strategy is mentorship. Guide a family member or friend through these steps to help them avoid costly errors. Teaching this framework clarifies your own decisions and maintains consistency in your financial habits over the years. Start this journey with a simple action scheduled for this week, like interviewing an advisor or setting up a payment plan. Subscribe to our channel to continue building your homeowner system and share this video with someone ready to begin their journey.